Welcome back to Stock Kong Invest and Analysis, where we look at the market and break down the opportunities.
Like and subscribe!
ASML, why the next growth leg depends on post-2027 demand. This article was written by Dhiren Biche. Summary. Pause.
ASML is fully valued at current prices, yet I maintain a buy rating due to anticipated AI-driven demand beyond 2027.
Recent wafer fabrication equipment spending and TSM's capex increases signal robust, prolonged demand, supporting ASML's pricing power and future growth. Q4 2025 consensus expects $11.1 billion in revenue, plus 15.1%, and $8.73 EPS, plus 22.5%. With 2026 to 2027 growth hinging on management guidance. Double-digit revenue growth is projected to resume post-2027, with share repurchases enabled by a strong net cash position and improved free cash flow. I am Dhiren Biche. Using my aerospace engineering expertise, I provide a data-driven approach to investing ideas in the growing aerospace, defense, and airline industry. I run the investing group, the Aerospace Forum. ASML stock, ASML, has surged 32% since my last report, in which I downgraded the stock from strong buy to buy. With increasing wafer equipment spending, Q4 2025 earnings coming up, and the fact that the stock now exceeds my price target, it provides a good moment to revisit the valuation for ASML and update my price target and rating. A deeper look at wafer equipment spending increases. Stifel recently increased its 2026 expectations for wafer fabrication equipment WFE growth from 7% to 8% to 10% to 15%, which for me was a reason to provide a long-delayed upgrade on Lam Research stock. TSM's most recent earnings also showed a substantial increase in capex for 2026. TSM will substantially step up its capex from $40.9 billion in 2025 to $52 to $56 billion in 2026, with 10% to 20% earmarked for advanced packaging. TSM alone is stepping up capex by over 30%. Not all of that is for wafer fabrication equipment, but 10%, 20% is to address bottlenecks. That bottleneck is currently the packaging capacity that limits high bandwidth memory output and sends memory prices soaring. Important to realize is how this benefits ASML, because the HBM output is not lithography constrained, but packaging constrained, and ASML provides lithography tools. Additionally, ASML typically has lead times of 12 to 18 months for its machines. So whatever increase in WFE spending this year, if ASML were to benefit, it would only benefit the company from 2027 onwards. However, even if we assume that the benefit materializes later for ASML, the current investment increases show that demand is stronger than expected and stronger than the supply chain can handle. While foundry capex is cyclical, it provides a strong indication that demand will not suddenly taper, and that may provide a further indication that demand will be strong for a prolonged period of time, from which ASML could ultimately also benefit, as lithography investments may also be required to keep up with demand. That means that pricing power for lithography machines remains with ASML and actually strengthens, and for the companies developing memory solutions, there is a strong incentive to continue investing in next-generation memory solutions for which more EUV capacity may be required. Demand for NAND is increasing. There are various types of memory solutions, each of which has their own function. In Q3 2025, 35% of the end use of ASML sales was for memory. With high demand for memory, that share could increase. We also note that HBM is not necessarily the only growth driver. It is a major driver of growth. HBM is a form of DRAM, or direct random access memory. The other form is NAND, which is the core technology used in SSDs. We are currently seeing that demand for SSDs is increasing, driven by AI. Whereas HBM relies on EUV lithography, NAND relies on ARF immersion DUV lithography with multiple patterning. ARF immersion accounts for 52% of ASML's revenues. Lead times for ARF immersion DUV lithography machines have a 6 to 12 month lead time. So increasing demand could benefit demand and pricing power on ARF immersion lithography machines. Wall Street expectations for ASML in Q4 2025. For the fourth quarter, analysts are expecting $10.9 to $11.38 billion in revenues, with a consensus estimate of $11.1 billion, indicating 15.1% growth. For EPS, 8.45 to 9.01 is expected, with a consensus estimate of 8.73, indicating 22.5% growth. We note that estimates on revenues for the fourth quarter have remained largely unchanged, with a 2.3% increase in the last 6 months. EPS has increased by around 9.7%. ASML share prices fell in July 2025, when it shared that it could no longer confirm growth for 2026. Analysts are still expecting 7.7% growth in revenues and 8.4% growth in earnings per share. That is substantially lower than the growth rates of 28% in revenues and 44% in EPS expected in 2026. But perhaps we are seeing some strength in WFE spending supporting modest growth for ASML standards in 2026 before the company is expected to head for double-digit growth again. ASML stock is fully valued at current prices. To determine multi-year price targets, the Aerospace Forum has developed a stock screener that uses a combination of analyst consensus on EBITDA, cash flows, and the most recent balance sheet data. Each quarter, we revisit those assumptions and the stock price targets accordingly. In a separate blog, I have detailed our analysis methodology. For ASML, we note that the stock is currently fully valued. I am, however, maintaining my buy rating, as I believe that stock can still provide double-digit upside on continued AI-driven spending beyond 2027. We are also awaiting management comment during the Q4 2025 call, which could drive another round of upward revisions to estimates for 2026 and 2027. For 2025, expected EBITDA estimates increased 3.7%, while we see increases of 7.3% and 13% in 2026 and 2027, for a total lift of 8.4% in estimates. This increases the compound annual growth rate from 13.7% to 18.3%, measured from 2024. Free cash flow estimates for 2025 increased substantially by 21.9%, driven by better cash conversion, and by 11.9% and 17.7% in the years after. This indicates a 16.5% increase in expected free cash flow, and compound annual growth rate lifted from 1.9% to 7.5%. For 2025, a margin step-up is expected for 2025 with stable margins this year and another step-up in 2027 as revenue growth accelerates. Cash conversion for 2025 is expected to be lower after a year of strong conversion in 2024. Beyond that, the cash conversion is expected to settle around 65% to 70%. The company is already in a net cash position, and that means that the company can direct funds towards share repurchases. Conclusion: ASML's post-2027 expectations will be critical. ASML is currently fully valued through 2027, which means that normally the stock would be downgraded from buy to hold. However, I am awaiting management comment during the Q.
Hey viewers, like and subscribe to our channel. We'll keep bringing you more insightful stock analysis. It's going to be wild.